Hey guys, let's try to calculate beta today. So I'll be doing two examples, one for a listed company and the other for unlisted. The listed company beta calculation is pretty straightforward, but let's take 2 seconds to understand what beta is. So beta is a number that represents the sensitivity of a stock to the market. So how much would the stock change if the overall market changed, say X%, or to that degree? The formula for beta is covariance of the percentage change in stock and percentage change in markets divided by the variance of change in market. So this is usually calculated on daily. So here I have taken, I think, a few months of data for this company called Tata Steel. And for the market data, I've taken the index Nifty 50, which is an Indian index. But I mean, this can be applicable for any country. It's just that you should take a market representative index and calculate the high, low, etc. So let's let's make a column here for percentage daily change, and so we won't be needing low close or things like that. We just need adjusted close. So what I'll be doing is I'll be calculating percentage change. So this divided by this minus 1, this is 6%. I'll just be dragging this down. Yep. And similarly for the market data, sorry. And so now what we have is we have percentage change, daily percentage change in stock as well as daily percentage change in market. So what we need to do now is to calculate. I'll just delete this because I had calculated these earlier. So equal to covariance, uh, and we'll first take the stock, comma, then we'll take the market. Now what we need is variance of daily percentage change in market. So equal to variance. So remember, it's the percentage change and not just the change. And yeah, so now what we just need to do is divide covariance by variance, and we have 1.70. So this is how you calculate beta for a listed company. Now, one of the interesting things that's coming up is the valuation of unlisted companies, or more specifically of startups. And to do that, you need to follow a different approach, because startups may not necessarily be listed and you may not necessarily get their opening, close, and percentage change. So for that, what we need to do is use a different approach. So for example, here I've taken the example of Patanjali. It is an Indian FMCG startup. So we do not know the beta for that, right? But we do know its debt to equity, which is say 1.25. Now these are just random figures. Um, so before we get into this, what you need to understand is the beta that we have calculated here is the levered beta. Levered as in, there's the debt component involved, and we need the debt to equity ratio for that. So at least that should be available. And the tax rate would be something general like 25 or 30%. So what you need to do now is calculate the betas like we did earlier for larger companies within the same domain as the startup, who are listed and whose betas can be calculated. So for example, if Patanjali is a FMCG company, you can go look at HUL, Procter and Gamble, Dabur, etc. Calculate their betas. Now these betas are levered. We need to unlever them and relever them with respect to Patanjali's debt to equity. The logic behind this would be a bit long to explain right now, so you might just understand the process first. So we have the three betas, we have the three debt to equity ratios, we have the three tax rates. So we need to calculate unlevered. So let's have a look at this formula that I have input. What it does is unlevered beta is equal to levered beta divided by 1 plus debt to equity ratio, and that debt to equity ratio is multiplied by 1 minus tax rate. Alright, I'll just write it here. I should put equal to. Alright, so this is the formula to convert a levered beta into an unlevered beta. So that's what I've done for all these three, and then I've taken an average. Now you can assume this average unlevered beta as the unlevered beta of the industry. Now, to be more precise, you can look across larger companies. You can actually do a weighted average based upon market cap or whatever you feel is the right factor. But here I've just taken a straight up arithmetic mean. And so now what we do is we do the reverse operation here. So we re-lever the beta. So as you might have guessed, levered beta is equal to unlevered into 1 plus debt to equity into 1 minus tax rate. So that's exactly what I've done here. This is the unlevered beta of the industry multiplied by 1 plus debt to equity ratio of the company that we are trying to find into 1 minus tax rate applicable to that company. So that's how you calculate the beta for an unlisted company. So thanks for watching.